Hello, everybody, and welcome to the next installment of Butte County Library's REACH personal finance workshops and webinars. Today, we're going to talk about inflation. It's been really big in the news lately, and I thought it would probably be something that people would want to hear a lot about. I actually planned doing this earlier in the year when inflation, again, was a big deal earlier this year in 2022, and it still kept being a big deal. So it might as well get around to it now. So inflation is today's topic. Before we start, I just want to highlight that this is part of Butte County Library's REACH program, and the REACH program is about bringing economic empowerment and financial literacy to Butte County. And so we have a series of workshops, and they happen nearly every day on all kinds of topics, from business planning to personal finance to job searches to anything you can think of that could be considered economic empowerment. And so my series that happens on Fridays is about financial literacy, and we cover all kinds of topics about financial literacy things, stuff like saving for retirement, planning for the future, how today inflation affects our retirement planning. We talked about insurance in the past. We talked about working with kids, talking to your kids about money topics and helping them learn all kinds of really great stuff. So I highly recommend you go to buttecounty.net/BC Library, and you can search for the REACH program and see the calendar that covers all the different topics. We have live sessions that meet at the Butte County Library branches, and we have recorded ones like this one that's pre-recorded and released to everybody. So today we're going to talk about inflation. So what is inflation? It's the increase in prices of goods and services. And generally for our economy in the United States, we measure what we call a basket of goods. And that's just kind of phrasing that they use to say that there's a lot of different things and components that go into the measure of inflation. And so we usually call CPI, the Consumer Price Index, is our way of measuring how the prices of things change. And all kinds of components are included in that basket of goods. It'd be things like bread and milk that you buy at the store. It'd be things like gas that you put in your car. It'd be housing. It would be just anything that you can think of and consider that you as a consumer might be purchasing. Those are included in this basket of goods. Generally, when we talk about inflation, we talk about a percentage change year over year. So how did the prices of the goods and services that we all buy as consumers, how did those change in percentage terms compared to last year? And if you pay attention to the news, you probably saw, I'm recording this in June of 2022. And if you pay attention to the news, you probably saw that the most recent inflation number was 8.6%. And so what that means is, compared to 1 year ago, the change in prices was an 8.6% increase on average across all of the different things that they look at. And that's a little bit tough to understand, I think, for the average person, because like the price of everything didn't increase 8.6%. Some things increased a lot, like 20%. Some things didn't increase at all. Some things might have gone down in price a little bit. But in general, what they do is they take a look at what are people mostly buying, and people mostly buy things like food and gas and electricity and those kinds of things. And people don't typically buy as frequently, at least, things like, just off the top of my head, an example would be new tires for your car. You don't buy those as often as you buy food, right? You buy food probably every day in some way or another, right? Or at least you maybe go to the grocery store once a week or something like that. But you probably don't get new tires for your car every month even, or for a lot of people every year. And so, the increase in the price of tires doesn't have as big of an effect on inflation as the increase in the price of bread, for example. People buy bread significantly more frequently than they do tires. And so bread has a much larger impact on that inflation number, that 8.6%. So anyway, prices can go up a lot for some things and up or down a little bit for other things, and they take what's called a weighted average of all those different components, and they put that together to measure what prices overall look like for our economy. So how do we track that? Well, the way I just described is they take that basket of goods and compare pricing, but we describe that basket as the Consumer Price Index. And so in our economy, we have a Bureau of Economic Research, and then we also have the Federal Reserve, and we also have the Bureau of Labor Statistics, and those are all governmental agencies that keep track of these kinds of things. And the Consumer Price Index is just that measure of that basket of goods that I talked about. We report, I actually have to double check that. Report quarterly, I think. I have to double check if that's correct. The consumer price index is reported regularly, and it's quoted as a change over the previous year's prices. And the CPI includes tens of thousands of items. That one I do know. There's thousands and thousands of things included in there, but they are weighted average. So just because the price of cheese goes up, you might not buy cheese as often as you buy bread, or you might not buy one thing as often as you buy something else. And so those tens of thousands of things are included, but it's a weighted average of their price changes. And so the most recent inflation number was 8.6% as of, I think it was last Friday, that they reported that number. So also, in addition to regular inflation, like I've been talking about, we have a thing called core inflation, and core inflation is a measure of the things that are less volatile. And so typically food prices and energy prices tend to be very volatile. You know that by filling up at the gas station, that gas prices can be can fluctuate pretty significantly. They can go up and down quite a bit. And food is the same way. And whether or not you've noticed it, I think most people have, but some people maybe haven't. Food prices tend to be pretty volatile as well. And so sometimes, well, all the time, we take out those food and energy prices and measure what we call core inflation. And so core inflation is just a measure of the things that tend to be less volatile in terms of pricing. And some people like to use that as a measure of, well, if we take out the things that are really moving up and down, how much is it just in general, all the other things moving up and down? And that typically is used for decision making by the Federal Reserve, but I think the average person tends to spend a lot more of their disposable income, or maybe not disposable, most of their income on food and energy anyway. And so regular inflation numbers tend to be a lot more impactful for the general public as well. So CPI measures are regular inflation, and we don't really call it anything other than just inflation. And then core inflation is not measured by the CPI, but it's just a component that leaves off food and energy prices. Generally, core inflation is going to be lower than the overall regular CPI, just because the regular CPI is going to include those big movements in food and energy. But it doesn't have to be that way. And that's one of the things in the future you might think about, is that core inflation possibly could go up a lot if food and energy prices were to go down, but other prices were to go up. So what does historic inflation look like? So historically, inflation typically goes up. There's not a ton of times in our like history of our country where we've had what we would call deflation. Deflation would be the same as negative inflation. And you can see on this graph, this is a graph from the Federal Reserve's economic data, and it's FRED, which is published by the St. Louis branch of the Federal Reserve. And what they do is they put together a lot of data for consumers and for individuals to look at and be able to understand kind of what's going on in the economy. And so this is just a graph of the CPI, and it's not super descriptive to look at it other than to see, okay, yeah, prices go up over time. That's not very helpful, other than we can see in this gray, so all these gray bars, these vertical lines that are gray, indicate times where in the United States, this is a United States specific graph, that the United States was in a recession. And so recession is just two consecutive quarters of decreasing GDP, gross domestic product, which doesn't really mean much to the average person. But what we want to consider is that when the economy is shrinking, prices may or may not go up. They might go down. And we can see here, this is the 2008 financial crisis, this bigger gray bar here towards the right. And you can see that the CPI numbers went down during that time. We had deflation during that time, and then they went right back up, right? And we can see this very skinny bar. You can almost not even see it. It's a really narrow gray bar right here at 2020. That is the COVID recession. And it's very narrow. This is a very zoomed out graph. It goes all the way from, I believe it starts in 1947, all the way up until now. So you can see that inflation has gone, this is a much more steep curve towards the end here. So inflation has gone up quite a bit just recently. And it went up a lot prior to the 2008 crisis. And you can see some of these other big recessions in the past. If we go here, this bar right here is the dot-com bubble. And we can go back to the 1970s here. This would have been the oil embargo in this range over here. And these are just historic events that caused recessions in the United States. And so that's fine to look at, okay, CPI goes up, prices go up over time. We all kind of know that, right? We all have the idea that, you might think of your parents or your grandparents telling you a story back in the day where they say, back in my day, prices, you could get whatever for a nickel, and that kind of stuff. prices tend to go up over time. And so that's what this graph illustrates. But I'll have another graph in a minute that shows a little bit more descriptive of how inflation looks. So what causes inflation to happen? So inflation happens when prices I may have phrased this wrong. Prices go up, and that's what is inflation. You can have low inflation where prices only go up a little bit. So I said here, inflation happens when prices are too high. And that's probably bad phrasing on my part. What I mean is inflation is the increase of prices. And so what we notice is when that inflation number is too big, right? Right now, we know that inflation is really high, prices are up. 8.6% inflation is pretty high historically speaking. And so we're not super happy about it as consumers, right? We're not happy that our prices are going up. What causes those prices to go up is mostly two components here. There's supply and demand, and we know that supply and demand dictate pricing, right? The demand piece is that if a lot of people are buying things and willing to spend more money to buy those things, prices will go up to match that, right? If I'm a business and I have a limited number of widgets to sell, and people are clamoring to buy my product, I would say, well, I want to sell. I'm probably, if a lot of people want to buy my product, I'm probably going to sell out no matter what. I'm going to sell all of my product, and I'm going to sell out no matter what I do. But if I were to price higher, then the people who are willing to purchase it for more money are still going to buy it. And the people who aren't willing to purchase it for more money aren't going to, but I'm going to sell out anyway. I might as well sell it for more, right? That's demand-driven inflation. I'm going to increase my prices because people are willing to pay for that. And I'm a businessman. I want to get the most money I can. I want profit, right? That's demand driven. Supply driven is when I need to increase prices because prices are increasing for me. If I'm a business owner and I'm selling products and I have to pay a lot more for fuel and shipping and raw materials and all kinds of other things, or maybe I just have less things in general. I don't have as many to sell. If I can't produce the total amount that I wanted to. Those are going to be supply driven inflation numbers, right? And so I need to increase the prices of what I'm selling in order to make a profit at all, or because I don't have a lot to sell anyway. So the few that I can sell, I'm going to sell for as much as possible to try to make up for that lost profit. So supply and demand tends to drive our inflation numbers. And how did we get to where we are now is both both supply and demand have driven our current inflation numbers. And so if you think back just a couple of years during COVID, we had a significant drop in supply of all kinds of components to products. People were working less, right? They were staying home because they were quarantining or they were just, trying to stay healthy. And so businesses produced less goods and services, right? And so by having lower supply of components that are needed down the supply chain, we had supply chain crises happen. So you probably remember that in the news over the past couple of years. Well, at the same time, we have people receiving stimulus money, right? And so they have more money, at least maybe not more because maybe they're working less, but they have some money coming in and they need to spend it. And a lot of people are spending a lot of money, and we have more money in our money supply. I'll talk more about the Federal Reserve and money supply in just a minute, but we have more cash available to people, and so they can spend it. And so people are going out and spending a lot more than they normally would, and so there's more demand. And so both of those things together cause an increase in inflation. And we haven't really gotten out of the supply side. There's still supply chain issues going on, and the components for producing products, fuel costs, for example, are just really driving up the component costs of creating materials. And so it's going to keep happening that inflation is going to keep increasing unless we do something about it. And I'll talk about what do we do about it in just a second. So this is a different graph, same concept, same idea, except this is inflation reported as a year-over-year change. So this is the percentage change. So up and along the left axis here, the y-axis on the left is percentage. So 15% is the top, and then 0% is that solid black line across the bottom here. And so you can see historically in the 80s, we had in the 70s, we had really high inflation, and that had to do with a lot of things. So there's a lot of components coming together. We left the gold standard in 1971 as a result of the Vietnam War. We had easy lending policies going on in the 60s, which led to the inflation of the 70s. We had the OPEC oil embargo, which caused fuel prices to increase dramatically in the 70s. Lots of things happened then where we had really high inflation, and the highest interest rates that we ever saw in our history of the country was in the 1980s, early 80s. I believe it was, I want to say it's April of 1981 was the peak of interest rates, but I'm not 100% positive that that's the right date, but I think it's close to that. And then since then, we had inflation come down and stayed at a relatively stable number, somewhere between that 3 to 5% range is okay for a long-term average. Actually, the Fed targets about 3%, 2.5 to 3% is their long-term target. And you can see that around the 90s to the 2000s, that seemed pretty normal, except in the Great Recession in 2008. This actually was 2009. We had deflation where it just went down just a little bit, just below that zero for a little, and then it came back up, and then we were bouncing around, and now we're kind of coming back up again. And so this graph actually gets cut off before 2022, but we are at 8%, which means this line, if the Federal Reserve website had updated this graph, it would continue on to the right a little bit and come up about even with, I'm not sure if you can see my mouse, but about even with this 1.5 more bars up from there. And so that's historic annualized percentage change in inflation. And so generally we like to see that number be closer to the 2-3% range. And people typically are okay with prices increasing about 3% a year, and they don't tend to get so angry about it, because generally you might have a cost of living increase, you get an annual raise or something like that at work, and if it keeps up with inflation, people generally aren't upset, right? You get paid a little more, things cost a little more, but overall you kind of break even. But when prices are going up too much and people aren't making more money to cover the increase in prices, people tend to get upset. So what does the government do about inflation? So the Federal Reserve is our central bank. And so the central bank for any country is the bank that's responsible for the money supply and managing the economy. And in the United States, our central bank is called the Federal Reserve. Other countries have their own central banks. There's a Bank of England, there's a Bank of Japan, there's the ECB, which is the European Central Bank. There's different central banks all around the world. The Federal Reserve manages our economy. They're the United States central bank. And so what they do is they're responsible for managing interest rates and the amount of money that exists in our economy. And they try to keep inflation in line by managing interest rates and the cost of borrowing and the amount of money that exists. Remember, I said earlier that inflation is driven by either supply or demand usually, and a little bit of an expectation of inflation gets mixed in there too. And so the Federal Reserve says, well, if people are buying too much, if there's demand-driven inflation, meaning people have more money than they need, so to speak, and they're spending it to buy a lot of things, that's going to drive inflation. And if we make it harder for people to borrow money and harder for people to get money, then they're probably going to spend less, right? Because it's harder to get money. I'm not going to go out and spend, frivolously if it's hard for me to get money. So the Federal Reserve might try to increase interest rates to disincentivize people from borrowing so that they won't spend as much. And there has, multiple factors that come from that affect other pieces of our economy as well. And I'll talk about that in just a second. So the Federal Reserve has kind of two big things that they do. They set target interest rates, and they really can only set the target interest rates for their short-term debt that they give out, that they lend or borrow for the economy. Long-term interest rates are more set by supply and demand and investors who buy and sell government bonds. And I won't get into that detail. That's more something that I would teach my students at Chico State, the senior finance students. But generally, the Federal Reserve will manipulate interest rates, and they will manipulate what we call the money supply. And to make more money or take money out of the economy, what they do is the Federal Reserve has the ability to buy and sell government bonds. And so they will buy and sell bonds to banks. Then banks will either have more cash or less cash on hand based on whether they bought or sold bonds. So if the Federal Reserve were to sell a bond to a bank, they would give that bond to the bank, and the bank would pay the Federal Reserve money for that. And if the bank paid the Federal Reserve money for that bond, then the bank would have less money, right? And reverse that. If the bank were to if the bank were to sell a bond back to the Federal Reserve would pay money to the bank for that bond. And so the bank would have more money on hand. And so And so if the bank had more money on hand, they could then lend that money out to borrowers. And you can think for yourself, if you were going to borrow money from a bank for a mortgage, for a car loan, you might get a credit card from your bank. You might get, there's all kinds of things that you might want to borrow money from your bank, or reasons that you might want to borrow money from your bank. And so by lending that money out to the public through mortgages or car loans or whatever, there's now more money in existence, and people can buy things. They can buy cars, they can buy houses, they can refinance, or they can get a HELOC and make an addition on their house. There's all kinds of things that people spend money on, and they borrow money to do it. And so that's how the Fed manipulates our money supply. But for inflation, the money supply is one big component to that, and the interest rates are the other big component to that. And so what does the Fed do? So they're given a dual mandate, and that's like a little bit of a misnomer. Dual mandate actually includes three things that the Fed has to do, even though it says dual. And so the Fed is responsible for keeping prices stable, which is inflation, maximizing employment, which is our unemployment numbers, and then keeping long-term interest rates moderate. And the Fed has a bit of a juggling act to manage when they do these things. It's really difficult to keep all three of those things in line, and there's always something kind of getting out of whack, and they have to try to bring it back in. And so right now, that stable prices piece is the biggest concern for the Fed, and that has to do with inflation. They want to keep prices normal, or at least they can grow a little bit, but they're growing too fast now. And so that stable price piece is what they're focusing on. So inflation's okay to have if it's like low inflation, right? 2.5%, 3% every year, not a big deal. People don't typically worry too much about it. But if it gets to be 8% like it is now, then people get pretty angry. Maximum employment doesn't actually mean everyone has to have a job all the time. It's okay to have a little bit of unemployment in an economy, because if everyone had a job and no one was looking for anything else and everyone was exactly where they were, then no new businesses could get created. Nobody could move to other jobs, right? It would be pretty difficult for our economy to function. And then last is moderate long-term interest rates. And moderate long-term interest rates just means that the Federal Reserve is trying to keep interest rates for borrowing at a medium level over the long term. Over the past few years, they've been essentially zero. And after 2008, after the Great Recession, they call it, interest rates were dropped to close to zero and kept there for a while. They came up a little bit around, I think it was 2015 or so, but then they came right back down again. And so we were at this zero interest rate for a while, and people were able to borrow. And you probably, if you keep track of like mortgage interest rates, you probably saw that people were getting like 3% mortgages and less than that sometimes. I have a friend who I think had a 2.5. He was able to get 2.5% interest rate on his mortgage. So you've probably noticed that interest rates are really low recently. Then it's pretty too low, right? And so the Fed needs to bring those interest rates back up, but they don't really want to make them really high, right? They want to make it kind of average so that people are okay. Like if everything was just right in the middle, everyone would be happy. But in order to reverse some of the issues that they've had recently, they have to kind of go too far the other way and kind of ease it back. And that's kind of what we're going to be doing here in the near future. So how does the Fed combat inflation? So we have their dual mandate. We know kind of what they do. They can buy and sell bonds. They can set interest rates. So how do they use that to combat inflation? So if prices are too high because of demand, the Fed can reduce demand by making it harder for people to get money. They increase interest rates, people can't borrow as easily, they're less likely to spend, and then prices tend to start coming down because people are spending less money, right? And so businesses tend to lower their prices so that people will be incentivized to come back out and buy something. You say, oh, that's pretty cheap, okay, I can afford that. But if something is really expensive, you say, I'm probably gonna either buy the cheaper version, or I might like make do with less now. There's a few different ways that people try to get by with less money or when prices are too high. And some of those ways is just to defer consumption is what we call it. And so people just don't buy things, and sometimes it's things they need, and so that tends to be a little bit of an issue. But if you were thinking about buying a house right now, you might realize, hey, you know what, interest rates are going up a lot, and maybe I don't want to buy a house. We might start seeing housing prices coming down in the near future. You probably already have seen it in this is for Butte County, right? So if you look on Zillow, I've seen quite a few houses recently that have had price cuts, and you probably start seeing housing prices coming down quite a bit in the near future. Because interest rates are going up. And so when interest rates go up, it means the cost to borrow and the cost to buy a house goes up. Even though the price of the house may go down, your mortgage payment might be higher because the interest rate on your mortgage is so high. And if prices are too high because of supply, the Fed can't do a ton about that, right? That's a supply chain issue, right? The Fed can't control supply chains, but if they can get prices to come down, then the component factors of producing products could hopefully be less, which means products can sell for cheaper and then people could buy them. And there's kind of a multi-step process to this, and it's really difficult. I had it explained to me when I was a college student years ago by one of my economics professors. He said it's like trying to drive a car, like the Fed managing the economy is like trying to drive a car where when you turn the steering wheel, you have to wait 5 seconds before the car actually turns, right? If there was a huge delay between when you turn the steering wheel and when the car actually turns, that's like trying to manipulate the economy by the Fed. Is they can do something, but it won't have an effect until months maybe later. And so it's hard to control an economy with that amount of delay built in. So here's a graph of historic interest rates. And like I said, in the 80s, we had really high interest rates. People were getting mortgages at like 15%. There was, credit cards at the time were in the 30s. There was all just, interest rates were really high. And we haven't reached that point yet, but it's possible we could. Probably the Fed is going to do whatever they can to make sure that doesn't happen, but nobody can predict the future. This graph kind of cuts off at 2021. Unfortunately, that's just the way that the Federal Reserve's data is updated. But you can see, that the 80s was our peak, and it kind of ran up from I think this starts in 1937 or so, and comes up and it peaks in the 80s, the early 80s, and then it comes down since then. But this is the 3-month Treasury bill, which is government debt. It's a 3-month debt, kind of like just a quick borrowing kind of thing for our government. But it's a good tracker of what other interest rates look like, right? Typically, we use the 10-year Treasury bill to kind of look at mortgages. Typically, people live in a house for about 10 years, and so we use the 10-year Treasury as a stand-in. This is a 3-month Treasury. It's close. It's going to be the 10-year Treasury is just going to be almost this exact same graph, just shifted up a little bit. But that's the idea. And so you can kind of see how historic interest rates have changed over time. And if you know anything about like economic history, you can kind of see how they've changed right up until a recession happened, at which point generally interest rates come down in a recession. But we're now at the bottom, right? So since 1980, every time there's been a recession, we've lowered interest rates, right? And then so 1990, there was a small recession, we lowered interest rates. 2000 was the dot-com recession, we lowered interest rates. 2008 was the Great Recession, we lowered interest rates to 0. And then we brought them up just a little bit, and then the COVID recession happened, we brought them back down to 0. And now they're going to come up again, and maybe there'll be another recession, and then they'll come back down to 0. Maybe, I don't know. It's hard to deal with that. And so we're at the point where we have inflation and we have like economic issues for like GDP and production, and we want to make sure that like we don't tank our economy. It's a balancing act for the Fed. So you might have heard of a phrase called stagflation, and that's a big thing in the news right now. Stagflation is when the economy is stagnant. We're not producing as much. We might have low employment, meaning high unemployment. A lot of people are unemployed. We're not producing a ton, but inflation is really high. And so we have a lot of demand, but not a lot of supply and not a lot of production. And how do we get out of high inflation is by increasing interest rates, constricting our money supply, making it harder for people to buy things when they're already unemployed. And so stagflation is a really difficult issue for the Fed to deal with because people are already struggling and prices are really high. And in order to bring those prices down, we have to make people hurt. Unfortunately, that's just the way it is. And so the Fed is going to increase interest rates. Are we currently in stagflation? By like strict definition, I think not, but it's like for these definition terms, there's the Bureau of Economic Research like keeps track of are we in a recession? Are we in a depression? Are we in stagflation? What does inflation look like? And the actual like experience for people, for our society, and whether or not by definition we're actually in a stagflation environment doesn't matter, right? We don't care what it's actually called, we care about our experience. And when prices are really high and we don't have money to spend, we feel like it's stagflation, whether or not we're actually technically within the definition of stagflation. And so that's kind of what it feels like right now. Prices are high, people don't have a ton of money, it's hard to afford a home, it's hard to afford just fuel and food, and that's kind of where we are. So in the 1970s, we had stagflation, and that was due to the OPEC oil embargo, also due to coming off the gold standard and a lot of other things that were going on at the time. And so the Fed had to increase interest rates. And if we go back up real quick to one of those previous slides, let's see if we can do that. In the 70s, we started increasing interest rates quite a bit to combat that. But then we had a recession in 74. And so they had to lower interest rates again, and then they had to increase interest rates again. It's really difficult. It's that delay driving the car and the delay between steering and actually turning that's going on here. And so the Fed has to juggle all of that. And we got the highest interest rates of all time right at the end of the 70s and the early 80s as a result of all the things going on in the 70s and that 70s stagflation. So how does this affect the stock market, and why does this affect the stock market? How come when the Fed announces they're going to increase interest rates, stocks go down? And why have we seen since this year the stock market essentially went down? I should be specific. The S&P 500 is what I use as the stand-in for the stock market. And that's gone down about 20% so far this year. Why? Well, stock prices are built on expectations for the future. When people are buying, well, the individual people probably spending a little bit of money, buying stocks for their retirement, might just buy blue chip stocks, right? You buy Microsoft, you buy Dow Jones type companies, you buy ETFs and mutual funds and those kinds of things. But big, what we call institutional investors, the people that really drive the movements of the stock market, they are buying and selling stocks based on their expectations of how those stocks will perform in the future. And companies perform financially based on their profits after their costs. And the two ways that companies can fund growth and to build into the future and become bigger companies, there's only two ways to finance a company, and that's by selling new shares and borrowing money, right? They have internal financing where they sell products, but that's just part of the equity piece, which is selling shares. So selling shares and borrowing money. And if one of those components, the borrowing piece, is more expensive, then companies are going to grow slower, right? They have to borrow money to grow and to build a new factory and to produce new ideas and to do all these different things. And if it costs more to do that, then their after tax, their after costs profit, their net income is going to be lower. And so if a company has lower net income, then shareholders are going to receive lower dividends. They're going to receive lower capital gains. And so generally people aren't willing to sacrifice their own income. And so they'll sell that stock and try to find something better. And so the stock market comes down when costs of borrowing goes up. And so what's causing the cost of borrowing to increase? The Federal Reserve raising interest rates to slow economic growth, to lower the inflation number, which causes stock prices to go down. So stocks become less attractive to own when interest rates go up. And that's kind of where we are. And so the market's been tanking quite a bit so far this year. It happens regularly, unfortunately, every 10 years or so, we have a market crash. And we're kind of due for one, right? Our last big market crash was 2008. We had we had one that kind of started at the beginning of the COVID recession, but then came back, and the market did really well during COVID. Surprisingly, the tech stocks did, because they were able to adapt to this work from home environment. But now we're kind of coming the other direction. So how long does a recession like this normally last? So a bear market usually isn't very long, right? It's sharp and fast and comes down, and then the growth piece tends to be longer, more drawn out, slower. It doesn't come back up nearly as fast, but it grows over 8 to 10 years. And then sharp, quick drop grows over 8 to 10 years. Sharp, quick drop grows over 8 to 10 years. And it's kind of a repetitive thing. And that's just the market cycle. So if I could say anything to anybody who's watching is, it's going to be painful in the short run, but if you stick with it and hold for the long term, typically you'll be fine. Generally, if you look at the S&P 500, there is not a 10-year period where if you held S&P 500 stocks for 10 years or longer, there is not a time period where you would have lost money. The longest time period, I think maybe in the 70s, and then from and then also from the peak of the dot-com bubble to the peak of the Great Recession, right before the Great Recession, was 8 years. It was like 2001 to 2007 or so. And so that's going to be like the longest time in which you could have bought at the very top, and then the market tanked and you wouldn't have become profitable for about 7 years. That's about, historically the long term in terms of if you were going to lose money. But if you're willing to stay in the stock market for longer than 10 years, there's not a time in history in the United States where you would have lost money over 10 years or more. Except for the NASDAQ, which is a really specific, you don't necessarily have to be in tech stocks all the time. So the NASDAQ is a really specific kind of investment where they lost money, and they have lost money from 2000 to about 2015 because tech stocks in the dot-com bubble went up too much, way too much. It was a bubble. and they came down and they stayed down and they didn't recover the full growth that happened in the dot-com bubble for NASDAQ until 2015. And so I would just say if you can be, broadly invested over, we call it diversification. If you watch the previous Butte County Library Reach videos, you can see what my conversations on diversification for your retirement account. But if you're able to be well diversified in your retirement savings, you're going to be okay for the long term, as long as you have 10 years to go before you retire. If you're going to retire in less than 10 years, then you're going to want to work with a professional probably to figure out what your retirement plan looks like and whether or not you should get out of the market, and if you should maybe go to things less risky, maybe go into more bonds or other types of investments. You're going to want to talk to a professional about that. So that's kind of our conversation on inflation and how it affects the markets and how it affects you. Here's some references I think are important if you want to learn more about it. Investopedia is a great website, and they have they're essentially the Wikipedia of finance. And so they have a dictionary and inflation. They have a very long article, but it's actually really informative about different kinds of inflation, how it affects the economy, how the Fed tries to combat inflation. BLS, which is the Bureau of Labor Statistics, they have a Q&A session on CPI, which is a consumer price index, and that's our measure of inflation, really detailed in the actual process of how they go about measuring it and how they actually poll for the different prices and how they construct the basket of goods for CPI. Very detailed, almost like a master's level kind of Q&A about CPI. And then FRED, which is the Federal Reserve's economic data for the St. Louis branch of the Federal Reserve. They have all of the graphs that I used, if I go up here, these graphs come from FRED, and I use them in my classes at Chico State when I teach finance. I use those graphs to show students about historic things for our economy. So be sure to join us for the next Butte County Library Reach webinar. They happen every Friday. One Friday each month. The first Friday of each month is live, and then the subsequent Fridays of each month are pre-recorded. And please reach out to me if you want. financialwellness@csuchico.edu is my email. You can email me there if you have any questions or if you want to see other topics for future videos. Thanks everybody for watching. Have a great rest of your day.